Let's look at internal rate of return. What does that actually mean, or IRR? Well, it simply measures the average annualised rate of return on an investment, compounded generally annually through the life of that investment. It's different to the average annual return. So for example, if you had an asset that you purchased for say $100,000 and you sold 5 years later for $200,000, excluding any income that might come from it, well, you've made 100% on your money, and over 5 years that's an average of 20% per annum. But what the internal rate of return does is assess that return based on compounding each year. So what may be an average 20% annual return across that asset would actually be, on an internal rate of return basis, 15% per annum, because you're adding 15% each year. And internal rate of return is the common industry metric used for assessing the total return on an asset. It's particularly relevant when you've got uneven cash flows. In that simple example I gave, it's pretty easy to measure the total return and simply divide that by 5. But if you were looking at uneven cash flows, you might get some capital back, or it might be an income stream with some lumpy payments on the way. Internal rate of return is generally the measure that's considered more relevant and more accurate in assessing your total return. Be aware though, when you see funds or any investment promising an internal rate of return, particularly if it hasn't eventuated yet, the asset hasn't been sold, they are quite reliant on the ultimate exit value of that asset. So as well as looking at what the final internal rate of return might be, also it's important to consider the cash flow on the way through, particularly early on, because that's more certain than what the ultimate sales price might be, which is still obviously subject to market forces at that particular time. Also, the other thing I think every investor should be thinking about when looking at internal rate of return, particularly on forecasts, is the risk. Anything that is high risk, you should expect a much higher internal rate of return. For example, a property development project, you generally would be expecting 15 to 20% internal rate of return, because that's high risk and the cash flow comes all at the end, generally in a lump sum. On an asset that might be a passive income stream, where it's paying a yield from day one, you might be expecting a lower return, perhaps somewhere in the order of 9 to 11% total internal rate of return over that journey. So it's an important metric to consider. There's lots of obviously things that go with it, such as risk and obviously the assumptions and exit price, which will impact the internal rate of return. But hopefully that was a good summary to give you a basic idea of what that stands for when you're looking for your next investment.